Hey everyone, it's Brandon from the Young Investors Podcast. Myself and Hamish are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started that any advice provided by myself is general and does not consider your financial situation, needs, or objectives, so consider whether it's right for you. Brandon Kolk is authorised to provide general financial product advice in Australia and is authorised representative 1305795 of Guideway Financial Services Proprietary Limited, AFSL 420367. Please see the description box for my financial services guide. Past performance is not a reliable indicator of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast. All right, everyone, welcome back to yet another episode of the Young Investors Podcast. We got a special treat today because we have a very special guest. You've seen him on my channel before, and I think you've seen him on Hamish's channel as well, but I don't think you've seen him on the Young Investors Podcast, and that person is Matt Peterson. Matt, how are you going?
Hey, it's very nice to see you. I'm glad we can make this work, Brandon.
Yeah, it's good to have you on. So for those that don't know, Matt runs Peterson Capital Management, which is a fund over in the US. And I met Matt, when did I meet you? 2 years ago, I think. We met at the Berkshire meeting.
Yes, we did.
And Matt, you run a Berkshire barbecue. A couple of days before the meeting, where Matt's super nice. He just invites everybody to come along to this barbecue, and it's just a whole bunch of value investors hanging out. And myself, and actually you knew Tom, investing with Tom, and then we were going over with Tom, and Tom was like, you guys got to come along. And so we all met up there, had a great chat to Matt, and then after all the Berkshire meeting had finished, myself and Hamish and Tom were just kind of going on a bit of a holiday, and we went to Texas, and that's where Matt lives. So Matt, you were very kind to invite us for a lunch, and we went around the city, and you were our tour guide, and we came and recorded a podcast with you. So
yes,
and the friendship was born.
And I think if I remember correctly, Brandon, you had all just gotten COVID tests, and somebody had given a warning. They felt fine. Tom had said he felt fine, but tested positive. And then everybody came to the house. And I said, so what's the deal with COVID? Did you test positive, Tom? And you were like, yeah, we all tested positive. And we said, well, I guess you're here from Australia. Let's just kind of have some social distance. Come on in.
Yeah. We did the most socially distanced podcast you could imagine. It was quite funny, but it worked out quite well. But yeah, it's crazy looking back to that time now. These days, like, no one would even care anymore, right? If you had COVID, they'd just be like, oh, get on with it.
Perhaps, yeah.
So I know you decently well, Matt, from hanging out with you and talking to you over the years. For those that are listening to the podcast that don't know you, can you kind of explain, who you are and also what Peterson Capital Management is?
Yes, definitely. So I've had about a 25-year career now. I began out on Wall Street. I worked as a consultant for a bunch of companies, including Goldman Sachs, as a risk manager for many years. So I was doing market risk and credit risk primarily with Goldman in both New York and London through the financial crisis, et cetera. And I left to go start my firm 2010. We opened up in 2011. So the firm is 13 years old. And we've been running a long-term concentrated portfolio in the style of a Warren Buffett investment fund for the last 13 years. And we've done very well. We have double-digit net returns. We have some very interesting holdings. We have some quite advanced AI and technology that we use, and even some proprietary strategies where we found alpha. So we have quite an interesting, I think, portfolio, and it's been really evolving over the last 13 years. And so here we are today.
I think that's the one thing I took away from your annual meeting slides, is that you kind of start with this Warren Buffett strategy, but you also implement some other strategies on top of that, which kind of help to boost things along. But to start with your kind of core philosophy, you talk about it's a Warren Buffett-esque portfolio. What does that kind of mean for those that don't know? How do you interpret it? What are your investing philosophies?
It's a great question. There are many different ways to put capital to work in the markets, but Warren Buffett has been successful over 6 decades following methods that were proposed originally by Benjamin Graham, other methods by Phil Fisher. But these are long-term investments where the intrinsic value is significantly greater than the market price, and you're looking to buy something for much less than it's worth and hold on to it for the long term until the price appreciates to its intrinsic value. And I think the main difference between Ben Graham and Phil Fisher is that Ben Graham didn't care much about the underlying business, the business model in itself. It didn't matter much if it was growing or shrinking. It could even be a terrible business if you get a great enough price. When you move over to Phil Fisher, it's more about really outstanding opportunities, growing opportunities, businesses that are really high quality, business models that are high quality, management teams that are high quality, where you can pay up a little bit, but now you own something that's a true treasure. And we are really aligned with that. We're really aligned with trying to find infinite compounders. Things are going to grow at abnormal rates of return for a long period of time, in some cases decades, and we're looking to really buy a piece of the underlying business. So obviously, if you have a certain amount of shares outstanding and you have to go out and buy, say, 10% of those outstanding shares, you own 10% of the assets, the liabilities, the cash flow. And that's the mentality that we have. We look at ourselves as true owners of these businesses. We may only own 0.05% of something, but we think of ourselves as owners, and we really like to find win-win relationships, businesses that are really strong management quality that is outstanding, and great cash flow and earnings that's growing, that inevitably will pull the price upward. So that's what we're looking for, and we're very concentrated because it's very difficult to find an opportunity that would meet all of the various criteria that go into this. So in much the same way, the philosophy is very aligned, almost identical to the way that Buffett approaches his analysis and what he's looking to own.
So it's companies with a very long runway, like we talk about those long-term compounders, the ones that can continue to grow and grow. How do you kind of identify or how do you think about a business's ability to be a long-term compounder? What do you think about when you think, that business does have that long-term ability versus a business where you're like, I don't think it's got that long-term staying power?
There are many different unique aspects, but the reality is, in many cases, you're looking for, I think, a very unique skill set. It's usually not a commoditized type product. So If something's a commodity, you would need to have a competitive advantage that would give you staying power for the margins in your commodity. So that would be difficult. You'd have to be the low-cost producer of that commodity with some sort of structural advantage. So commodities in themselves often aren't in value type portfolios because it's difficult to find that niche where you have that staying power or abnormal margins for a period of time. So you're looking for true business models that have maybe certain aspects that would have a oligopoly characteristic, or maybe some sort of very unique aspect that's allowing it structurally to have an advantage. And if that advantage looks like it's able to persist, you really need to find these moats, as Warren and the late Charlie Munger basically defined. You need to say, well, there needs to be network effects, and this network's been built, and so it will be dominant. And you need to find the different business models and the actual moats that will protect the earnings and margins for a long period of time. And it can be other things also, just adaptability of a new service or technology would add a huge advantage. So of course, there's a huge runway coming now with AI and all of the capability. We'll see who the major winners are. But I think the clear winners, there will be a pile of clear winners, and those right now probably have some staying power. It's pretty hard to get a hold of the Blackwell chips and build yourself a server and make yourself an LLM. So that will probably give some large tech players some staying power and some reasonably high margins for a period of time in the future. So there are a number of different aspects, but it's really about finding the business models that can protect their economic moat and can keep earning, above average margins for a long period of time.
On that topic of an economic moat, this is obviously something that Warren Buffett focuses on a lot, making sure that there's some sort of advantage. But there are different types of advantages. You mentioned one of them being network effects. I mean, you can argue that Apple has a switching moat, it's hard to switch away, or a brand moat in the case of a company like Ferrari. Are there certain business models or types of moats or competitive advantages that specifically or particularly speak to you and your way of going about it?
There are certainly, I think investors lean towards certain industries or sectors that they can understand very well. And I think that there are some, I think it's really, Brandon, about understanding the economic staying power of any possible moat. So you can be in a situation, you need to understand the business model, and it's going to be unique for every single situation. So, and right. Moats deteriorate over time. So, I think an underlying theme that would collect the moats is that we're looking for off financial statement value. Okay, so what right. does off financial statement value mean? It means there's like a protected moat. Maybe it's a brand, and we know that there's extreme value in the brand, and maybe it's difficult to even calculate the precise value of that brand, but there is value. And so it gives us an additional margin of safety. So we might be looking at a company that requires network effects to be successful, a Meta, et cetera. And we may look at that and try to understand, is this moat valuable? Whatever the moat may be, is it valuable? Is it a positive value or negative value? And is it growing or is it shrinking? And if you are directionally right with that moat, it's off financial statement value, and it gives you some protection on the downside. Does that help, Brandon? It's like analyzing every individual moat when you come across that business. So you could have a regulatory moat if the government has provided FDA approval to some drug manufacturer. And that would be a very different kind of moat than a network effect with Meta. Yeah. Or some other type of competitive advantage, like a structural cost advantage, low cost producer. So each of those are evaluated differently, but that value, if it's off the financial statements, for us, we look at that as being unrecognized value. It's real, but it's not written up in the GAAP accounting figures. And so it's really not shown there. It's not accounted for by all of the people screening for PE, low PE ratios, etc.
Because you talk about this concept of off financial statement value to find the moat, do you have any tips for people maybe when they're kind of looking into companies, how they can identify whether a business has a moat?
The first step that we take in our fund every single quarter, and believe it or not, Brandon, this is just was announced today. I think we're leaning toward monthly releases of portfolio updates to the SEC. So any manager, okay, so I'll take a step back, but we start with a 13F filings and the analysis of what all of these great super investors have been investing in over the last 3 months. And it doesn't work if you're looking at a high frequency trader. It's sort of hard to follow Michael Burry because you don't know exactly what he's doing or when he's going to change something. So there are certain managers you have to be careful with, but every manager with over 100 million is filing to the 13F their portfolio holdings every 90 days. It's a beautiful thing because what we've done is we've put a lot of technology into our firm, but you don't necessarily need it. You find a few great managers. Look at Warren Buffett, look at David Einhorn, look at Guy Spear, and go and see what are they buying and selling. And usually, because they're great value investors, there's very low turnover. They've done hundreds of thousands of hours of work. They maybe have spent hundreds of thousands of dollars and millions of analyst dollars to figure out the position that they want to own. And then they back it with $1 billion of investment, or they put, a huge allocation of capital. So that's real conviction. So they may have been looking at 10 or 15 or 100 different companies, and they selected one, presumably their favorite best pick at the moment. And then they tell you. And that is so powerful, because what we do and what I recommend people do is we look at a list of 100 managers. Now, nobody needs to do that. You can look at 3. And we say, okay, in fact, there are studies going back that say if you do this with just Warren Buffett, you beat Warren Buffett. So basically, we look at the 13 Fs. And if we imagine 5,000 investable companies in the public markets in the US, when we look at 100 managers, because they're owning the same companies, we actually narrow down our selection pool to just 400. So we go from 5,000 to 400 every single 90 days. All right. Those 400 companies are a great place to start looking for moats. All right. Because many of the investors have found something. So you can go in there and you can say, okay, what is Fairfax Financial doing differently? Well, all right. They've got kind of some access to some very, very inexpensive capital. Is that a moat that's sustainable? It probably is. What's Markel doing? What's Berkshire doing? What is Daily Journal out there doing? Is there off financial statement? And they all have moats. So you just peel back these onions and you learn more and more about these companies. And when you start with this approach, you are spending more of your time focusing on great businesses, on great management teams who are doing great work with their firms. And I think generally you're learning more. If you just start with a pool of 5,000 and you're looking for an opportunity, I think you can search for a large part of your life and never find that needle in a haystack that's going to be that real gem you want to own.
So start with the 13 Fs, start by looking to the best investors that follow this kind of approach, and then almost reverse engineer.
Absolutely. And it's so simple that people struggle to do it. That's what makes it not easy. They think this, in fact, I think it's human nature. They want to take pride. They want to go and find their own new opportunity. And they want to almost have bragging rights of what they've discovered with their friends. But if the real objective is to compound capital, just look at what the experts who have spent decades of their lives perfecting doing, and choose within that pool. And we've done a lot of research, Brandon. So I'll let you know that we've found most managers don't take this approach. In professional managers, they actually go out and usually will start by screening, having models, etc. And what are the managers looking for? And what are retail investors looking for? They're usually screening. I mean, these are like Nobel Prize winning theories, but in economics, you win Nobel Prize for a ratio. Okay. So it's like, hey, what if we divide earnings by revenue? That'll be like Nobel Prize winning right there. So they come up with these ratios and they screen for them. So people are looking for low EV to EBITDAs and, PE ratios as a really simplistic form. Well, let's take PE ratios. Okay. So you're like, oh, I only want to buy a company with a PE ratio under 12. Well, you miss any management team who's reinvesting all the capital back into the business because the business is so strong. And so they don't have actual earnings, but they do have cash flow. So if you screen for the wrong metrics, you basically bring into your pool that you're going to be researching all sorts of false positives, and you miss all the false negatives. So you exclude a whole bunch of the needles in the haystack that you're supposed to be looking at, and then you include a bunch of things that you shouldn't be looking at. And so you're much better off to start with the 13 Fs, because if you look at the 13 Fs, they wouldn't filter well. We've been owners of a company called Daily Journal for about 5 years. And when we first started talking about the firm, the finances, and even today, the financials and the financial statements absolutely didn't match what was happening in the economic reality of the business. So if you are screening, you would never in your wildest imagination have daily journal fall into the pool of assets you should be looking at. And it's an incredibly strong, wonderful business. It's been over a double for us, and we'll hold it for decades.
A question I want to ask you is what, out of this process that you've followed, what's been your most satisfying investment? Is there one that stands out to you where you kind of followed this approach, you made a big investment and then it just really worked? Is there one that stands out like that?
I'm really pleased with Daily Journal, which we just mentioned, because in studying that firm, I think it makes me a better investor.
How so?
Because Daily Journal has been run for 42 years and put together by Charlie Munger and Rick Guerin, which is just hard to fathom in itself. You know, they started with a $2 million purchase of some newspapers, and now we have a 600 million market cap firm, and it took them 40 years. So over those years, these men that invented these ideas of moats just put everything they could possibly imagine into the structure of the business. So as you peel back the layers and the onion of everything, you just find moats after moats, and it's unbelievable advantages. Charlie Munger used to always talk about it like you can't teach the new dogs the old tricks. And so I go in there trying to figure out what all these old tricks are. And it's things like, it's things that are simple and not easy. It's like treating your customers right, not ripping them off. And guess what? It really works. So, and there's other obviously more advanced moats than treating your customers right, but you'd be very surprised the way that they go about the RFP process compared to their main competitor flips the whole IRR from a negative to a positive. And it's just because of Charlie Munger's genius. So all of these things help me to look for other things. And in fact, I run my business differently as I learn what they did with Daily Journal. So I learn the best practice that maybe isn't in the textbook because they just embodied that within Daily Journal. So Daily Journal is a wonderful business, and it is growing very quickly, and it's totally under the radar. First of all, you know, it was barely a 500 million. It was way under 500 million market cap when we were looking at it, built again by Charlie Munger and Rick Guerin, and packed with all, you know, there's 300 employees. They're all friends, and they've been working as colleagues with the greats for decades. So this is a really strong firm. You can imagine the off financial statement value just in the employees who have been listening to Charlie Munger for all of these years. We have done really extensive work with Daily Journal, probably owned it now for 5 years, researched it for 5 years, and probably went to the annual meetings for 10 years before we even bought shares. I interviewed like 50 employees. I even sort of crashed a corporate event where they were training all their customers, trying to figure out what the technology is actually building. And what we learned years ago is that they were building a courthouse case management software solution. Okay, so it's called eSuites. Journal Technologies used to run Justware, and now they run eSuites. They just closed down Justware. eSuites is basically a software service that it gets implemented to a courthouse. It's purchased on a license basis, usually a 10-year license by a county or a city or a state, and they implement a justice system software. And these courthouses are in a desperate need for a solution like this, and many of them, it's a really fragmented industry because in most places, there's just been a local team of technologists who have either hacked something together, or there'll be a small platform that a few courthouses use.
Which sounds odd when it's something as important as the courts, right?
That's right. So data integrity becomes extremely important, and even just the functionality is totally necessary. And it's strange because it's actually sort of a government service. And so they've actually got a big contract over in Australia, as you know. Mm-hmm. So these contracts are tens and tens and millions of dollars. And they are going to be very sticky revenue because once you're in one of these courthouses, all the staff learns and is trained and they never leave. So this becomes like a really beautiful SaaS, government SaaS model. they don't actually start billing their customer until they go live with the product, and that takes many years. So
Right.
they have all of these implementations taking place across the country. They're all very private, not well known, difficult to discover. And as those turn on, they get paid for implementation, and then they get paid their ongoing licensing, and then the licenses expand within the community. The number of licenses, the price of the licenses grow, and then there's a lot of services the public start using, like an e-pay it service where a traffic violation is paid online and you pay a $4.99 fee. That's all managed by the software. Or you can have e-file it if you're an attorney and you need to get documentation to the docket. You just pay $1
Right.
and scan this all. So the revenue will come gushing from the society's use of these products post-implementation. So we are right now in such an early implementation phase that there's not much revenue showing up. And so when we were looking, it was maybe 20 million or less of revenue. And now we're getting 50, 60, 70 million of revenue. And many years ago now, we were projecting 100 million, I think, by 2030, which they're going to meet, which is very actually hard to predict because they had nothing to show for it. So we were able to sort of assess the off financial statement value and say, this is what's coming down the pipeline, but you can't see any of it because it's not on the financial statements. So it screens very poorly. It's run by the greatest management team in the history of management teams. And the value is completely there. It's just off the financial statements. So that becomes an incredible opportunity where we say, look at all the moats in this business. Every time we look deeper, we find that there's a new moat, a network effect, a cost advantage, some other ancillary activity where they can provide a benefit to their customer. It's really an incredible thing, just high quality management, great capital allocation capability. And frankly, there's been a whole shift in management. You know, Munger passed away at 99 last year. And so Stephen Meinhill-Jones has taken over, and it's been a question in many people's minds. How is this going to work? The guys from Tiny, Andrew and Chris, brought Stephen to Charlie, and there was actually going to be a big merger. It's a very interesting story. Charlie didn't know what to do with Daily Journal as he was getting up there in age. And ultimately, Stephen stepped in, and he's doing a wonderful job. The firm is so connected. I've heard rumors that Lee Lu is helping him with the portfolio. I know they've just put up their Los Angeles buildings for sale. At least one of the properties is now for sale. It looks like they're really going with an asset-light model, which is much more aligned with the traditional SaaS business model. And it seems very appropriate for this firm. So when Salzman and Gurin and Munger were running things, there was clashes with their tech employees because they had just this century gap between the cultural challenges. And there was even, like, in the beginning of COVID, there was an issue, like Salzman wouldn't let some of the staff take the monitors to their house, but they needed them. And it was just not how the world works right now. So Stephen Meinhill-Jones has been such a welcome, refreshing leader at the firm, and he really understands how to make this work, and it's going completely in the right direction. It's beautiful, and we're just watching and rooting from the sidelines. So we actually own. I think it's wonderful because we have a very modest size fund. I mean, we started 13 years ago with almost nothing, so we're doing really well. And somehow our little fund owns, I think, 0.6% of Daily Journal. Who would have ever thought that we'd own 0.6% of a firm run by one of my heroes, Charlie Munger? It's just an incredible, I think it's an incredible thing. So it's very special to me, and I learned from it, and it's giving us returns. And it took a huge amount of work to uncover this off financial statement value. So in many ways, I do feel very strongly toward Daily Journal. I think it's going to be in our portfolio for decades, and I think it'll be performing very well for decades. So I do, you asked my favorite position. Daily Journal is one of them. Berkshire Hathaway is going to be one of them because it's just the entire ethos of the firm is based on, like, Berkshire Hathaway. And We've owned it since the beginning. In fact, when we were talking earlier, I think it's a nice milestone, although meaningless, but a nice milestone that today Berkshire touched $1 trillion in value for the first time ever.
That's wild.
I assure you, it's difficult to project how, 21 years ago, I was buying my first share and I think they were around $100 billion. And there is no way anybody would have believed me that it was going for $1 trillion. And we've been saying, by the way, it'll reach 1.7 trillion by 2030. So if anybody looks at our annual meeting, we've been saying that since 2019. And at the beginning, people were arguing, and now it's just obvious, like we just hit $1 trillion. So we're going to be at 1.7 in 2030. And I think Berkshire is a better index fund, especially where index funds are today.
Yeah, a lot of investors go with that approach instead of holding the S&P, which is very concentrated in technology stocks these days. The Magnificent Seven make up 30%. They look to Berkshire as a similar product to an index fund, although it's an index fund where the stocks that are put into that basket are selected by Warren Buffett.
First of all, just consider the advantage of being alive during a time when the best investor of the history of the world is alive and running a public company that you can just buy. And
it is amazing.
And he's paying himself, I believe, still technically $100,000 a year. Okay, so you just receive the top expert in the history of the world, and it's totally free. So for people that aren't eligible, we have accredited and qualified investors that meet the requirements for our fund, but other people come to us and they ask, what should we do with the capital? And almost entirely, I've told them to split it between S&P and Berkshire and then go do something else with their time. And those investors who follow those instructions do really well and also get to have all their time to go enjoy the rest of their life. So it is a totally reasonable strategy to just buy a huge position in a Berkshire Hathaway, walk away and never touch it. It's going to be just fine. And it probably beats the S&P 500, which, as you know, most professionals have a difficult time achieving.
Talking actually about Berkshire Hathaway and even talking about 13F filings from before, just quickly, I want to get your take on Warren Buffett selling his Apple shares, or he sold 50% of Berkshire's holding. Do you have any thoughts on that? Because interestingly, he's halved it and he's sold down to exactly 400 million shares, exactly, which leads me to believe that he's done selling.
I think it's a coincidence. If I had to project, I'd say at the time, right now, I do think he's probably done selling. But I also know it would be very strange for him to trim. That is not a normal thing for Warren Buffett to do. So perhaps he was looking to get a little more cash together. Maybe he has something in mind and he needs the capital. Also, Apple has run up quite a lot. Obviously, it's been an incredible investment. And I do think that Berkshire, in a way, has a real fiduciary responsibility to manage. They have claims and obligations and shareholders. And if it really became totally dominated by Apple, Buffett may feel a responsibility to make slight adjustments. But it's really, you let your flowers run. It's such a strange concept for people to grasp. And I think it was Munger. It could have been Peter Kaufman who put it out in this way. But I like the analogy, which is like if you're sitting around in your master's class or you're sitting around in your undergrad and somebody gives you a pile of money and says, okay, you're going to buy the future earnings. You're going to buy 10% of the future earnings of 3 students in your class. And you're not going to be allowed to change it. Okay, so you're going to go around your class. You're going to think very hard about who's going to maximize their earnings over the future of their lives, because that's what you're going to be buying. But then imagine you go forward 20 years and 2 of these students you've selected are earning millions of dollars a year and everybody else is earning a more reasonable income. And suddenly you look around and you think like, well, I've done so well so far. I'm pretty sure that I should take my money out of these and I should go and apply it to some of these others that haven't really bloomed yet. Well, that would be totally wrong because they're not going to bloom. You're already parked in the right vehicles. They're doing what you should be, and making that switch would cause, in many cases, tax liability. You'd end up with less capital than you'd start. You'd reinvest in a worse company. You'd have less knowledge about that new individual. You've known your original investment for now 20 years and you're watching their success. You now go to an unknown entity. So it is those types of reasons why I would not expect Warren Buffett to generally be trimming. But in this case, I sort of agree with you. It got so large, and I don't know if he wants all of that exposure or volatility. I don't think we're headed for an immediate recession at this time, but we're right now on the brink of interest rates starting to come down. And we don't really focus on these macro events, but Berkshire although Warren often says you can't time the markets, he has been an extraordinary market timer over his lifetime. And how does he do it? I think the real way that he does it is he's analyzing opportunity costs relative to all the other opportunities. He's also incorporating the opportunity costs throughout history and potential opportunity costs in the future. And when he doesn't find something compelling, he's disciplined enough to put $280 billion in cash into an account and wait for years until there is that opportunity. So I think that in the long term, everybody will find that Warren Buffett made a smart decision again, whatever it is that he's doing. The nice thing is that you own Warren Buffett and Berkshire Hathaway. You don't even need to know exactly why, but it is generally probably a very good decision. And so, although we can speculate. We don't know if he's going to keep selling. It's not public information. I think he really likes his Apple holding. I don't think he's going to just sell all of Apple, but certainly trimming, and it's interesting to watch. There are a lot of interesting things that happen in Berkshire Hathaway, a little like Daily Journal. I think if you own it, you go to the meetings. I derive a lot more than just the financial value out of Berkshire Hathaway. There are these aspects of investing, and I'm sure you encounter it as well. If you buy a great firm and it's owned by another manager that you have respect for, et cetera, now you end up in a conversation with that manager. Now you're sharing these ideas back and forth. This is personal value that's even more than the financial value. So you can learn things from your various holdings. You can find all sorts of ancillary things. And through the ownership of Berkshire, through the ownership of Daily Journal, I think it makes us truly better investors. And I'd say right now, if you had to ask, I mean, there are many favorites throughout the fund's history, but Seritage has been a favorite as well.
That's an interesting one. I don't follow Seritage closely. Can you kind of tell me the story of that and how that all panned out?
So Seritage is a REIT.
Right. Real estate investment trust.
It's a real estate investment trust. And the REIT consists of the ex-Sears malls that were spun off of the Sears entity before it went bankrupt. Okay, so to give you a little more context, in the 90s, actually now I'm thinking it's 2004, but in many years ago, Eddie Lampert, who was once thought of as going to be the next Warren Buffett, decided to combine Kmart and Sears just pre-Amazon. Okay, so brought these two behemoth retailers together. And what happened is Amazon took over and they had lagging sales and it did not work. All right. So before Sears filed their official bankruptcy, because Eddie Lampert's a brilliant financier. So he was able to take all of this real estate that had a huge amount of value and create this sale leaseback model where they sold they put all the real estate into a REIT, and then the existing Sears stores began leasing from the REIT, and then Sears went bankrupt and he preserved all of the real estate value. And at that point, there were around 212 malls, and the price of Seritage was all over the place, and Warren Buffett bought some and some great investors bought some. We were looking at it. And when we were first looking at it, we do these things. It's as simple again, but it's not easy. When we needed to figure out the value of Seritage, we had to look at, what most were doing, what basically anybody doing a lot of work was doing, was trying to figure out what malls were Class C, Class B, Class A, and cap rates, and sort of these generic assessments. I started with Andrew, our analyst. This is years and years ago, and we just started figuring out the value of every single property. And we went one by one. We figured out the value of 212 properties, and
212.
Yes, and they take a long time because they're all unique. All right, so it's phone calls. We would triangulate between brokers, and what that then occurred is Seritage began this process. Let's fast forward a bunch of years. They were trying to grow them. At one point, it was compounder, and it looked like a great opportunity. So we were taking a position then. They then went into a liquidation period where they decided these malls are, they don't want to manage these malls internally. There's more value that can be created if they just liquidate the company and pay all the shareholders out in dividends. And when we looked at that, as the mall count started shrinking, it became much easier for us to have a really good grasp on what these values were. Because one, they were selling malls that we had previously valued, so now we could check our work. And two, suddenly, like today, there's just 22 malls left. 22 to
Well,
us.
I've sold most of them.
Yes, out of 212, they've sold 190. All right, so now with 22 malls remaining, it is so easy for us to sit and look, and they have some really nice Class A properties. They have UTC in San Diego, which is like $110 million mall when they sell it. They have Adventura, Florida. It's one of the greatest malls, and it's like a $200+ million mall when they sell it. So if you add up, so it's so simple. If you add up the last 22 malls that they're selling, and you subtract the basically 280 in debt and like 70 in preferred debt, which is 350 million. When you remove those and we look at about 100 million cost to complete the liquidation, there's still a lot of value left. And so it's very interesting. You can just divide by the shares outstanding, 56 million shares, and you can see, oh, okay, it looks like we'll get about $7 per share, but I'm not recommending to buy this stock. It's just a fascinating story. We don't own it. By the way, we exited around. We exited around 11. Okay, we ultimately purchased a little below 6, I believe. Maybe it was a little above 6. We only held the shares for about a year, but we watched this so carefully because we've been counting and valuing these malls for so long, and the price is just fascinating. You for people that think the market is efficient, just go and watch Seritage. It's definitely not efficient. There is a intrinsic value of these malls. These malls are not having more malls. These malls are not growing square feet. There's nothing happening. Most of them are empty. So there's no cash flow. They just need to sell the malls. So if you think you're going to sell the malls, bring in the money, pay off the debt, and then give it out as dividends, you can calculate that. So the shares have been from 11, 12 to 4. And the value of the malls they're not changing that much. So think about the opportunities. However, as it goes into liquidation trust, there's a few details. I would not necessarily buy. I would not buy. I do not recommend buying Seritage. I think it's probably going lower. But but you asked about the favorite investments, and Seritage is such an interesting situation that it becomes, it's one of these that resonates with us.
I'm interested, how did you find were all the sale values of these malls actually disclosed? So could you cross-check?
Oh.
No, they weren't. So you couldn't actually cross-check your own valuations that you guys did the work on with actually what they sold for?
Most of them, when they sell, many of them still remain private. However, However, we're so detailed in our modeling and analysis that we can see exactly what cash came in. Okay, they sold 4 malls last quarter and they have this much more cash. There's no other way that they're making cash other than maybe small triple net leases, and there's a little bit of cash flow in terms of their operations.
So you can broadly have a look at how well you did in your own valuation of these malls.
Not only broadly, it's pretty clear. Like if they sell 4 malls and we thought they were going to be worth, call it one large mall for 80 million and 3 small malls, and it was 140 million, and they brought in 155, we think, hey, that's okay. We were 10% conservative.
Pretty good.
That's pretty good. Yeah, that's right. We think we're pretty good. And we don't need to, we have bear cases, base cases, bull cases. So, and everyone's a range. So it's intrinsic value is not like a precise point. You're trying to find the off financial statement value. You're trying to understand the intrinsic value that the normal analyst doesn't pick up on.
Yeah.
And so
very interesting.
For that, it's often much better to be using a probabilistic mindset and then be using ranges of possibilities within those probabilities.
There's another business I wanted to talk to you about as well. We were talking a lot about Charlie Munger earlier. One of his final, I guess, investment decisions was to take a stab on one of the Chinese tech giants, that being Alibaba. And we know from, he spoke about this before he passed away, how, originally he bought it too high and he was a little bit over optimistic, and he got it wrong. Not to say that he didn't think the business was good, but he maybe bought in a little bit too high. And I was just noting before that Alibaba is also a stock that you guys follow. I'm wondering, this is one that I followed for a time as well. I'm interested to hear your kind of thoughts on Alibaba. For what I understand of it, it's a very integral company in terms of the Chinese economy. The Chinese macroeconomic situation is really having an impact on Chinese consumers. So they're not spending as much, and that kind of stems from their real estate sector, but they're not spending very much money. And a lot of these Chinese tech giants, which are, from what I understand, solid companies, have seen their share prices go down. We're talking like 70 to 80% from their peaks, which came a few years ago. So I'm interested, how do you view Alibaba? What's the thesis there? How do you see that company? And what enticed you to kind of explore it further?
It's a great question. And it's there's so many layers to the question and answer. Alibaba, in my perspective, is one of the cheapest large companies that exists in the world. And Charlie Munger, obviously identified this and pulled back on it. But let's just take a look at what's going on with Alibaba. Alibaba, over the next 10 or 20 years, will maintain its dominance as one of these key players in the large tech space. They're investing in AI. They're using the cloud. They're expanding all of their services. They're breaking up the divisions to decentralize the activities. These are all steps that they're taking to prepare themselves to just compete globally. And these platforms will exist. And there's a lot of, it's a really controversial holding because of the various opinions about China versus America, et cetera. Even the VIEs and ADRs are all under question. And a lot of this artificially puts the price down. And it makes people very concerned, but you have to go where there's like blood in the streets to find these great opportunities. It's not comfortable. Generally, it's not very comfortable to be a value investor if you don't really understand what's happening under the business. Because we look at Alibaba and see all of this cash gushing into the firm, and then them taking the capital and allocating it so strategically. They're buying back huge amount of their stock with the assets. They actually just did their Hong Kong upgrade today. There are so many things happening all at the same time. So they've they've just upgraded to a primary stock in the Hong Kong, which is going to allow the Chinese mainland investors to start investing more readily, funds investing into Baba. There are many catalysts. There are so many catalysts on the horizon. And I think I should point this out. I'm not sure if your audience is that familiar with puts and calls and things, but you mentioned at the beginning, we have these layers. So obviously we have a very core long-term compounding portfolio. Very little turnover, makes up the majority of the portfolio. We're identifying great opportunities, great assets. We're buying the assets and holding on to them for years. We're owners of these businesses. But to buy these businesses, we don't buy them like a retail investor through the New York Stock Exchange with a limit order. That's not at all what we do. And I haven't even done it personally for decades now. It doesn't seem rational because there's a cheaper way to get a hold of the stock, which is to write a cash secured put as a tool to accumulate the stock. So instead of buying Alibaba for $80, we can actually commit to buying it for $90, and somebody will pay us $20 to do that. And so if the shares climb a little bit during the holding period, that's fine. If it's above 90, we keep the $20 on our 70 in collateral, and we've made just a 30% return. And that's great. Let's say it goes out a year. So 30% return, and now we don't own any Baba, and we're back to cash. However, if the shares stay below 80 or 90, sorry, because I put the strike at 90 in this example, if the shares of the stock stay below 90, now in a year, we just buy the shares for 90, but it's only a net cash outflow of 70 for us. And so because of that, we're able to really move in below market prices. So for example, with Seritage, we were buying at prices that didn't exist in the stock market. Volatility is up, people are paying us a premium, and then we're sneaking in below the market. And when we exit, we use covered calls to exit, and we sell for prices above the market. So in a volatile company like Seritage, we can actually do very well. And in a situation like Baba, look, Baba is like a 200 billion market cap company with 50 billion in cash. They're in the process of buying back 35 billion of stock. So they're just wiping out massive amounts, 20% of the stock outstanding. And because of the volatility, uncertainty, et cetera, you're getting paid huge premiums for Alibaba. So every time there's a little dip in Alibaba, it's very easy to go out a few weeks, months, years, even, and write a few puts. And over time, these shares will be put to you, and you can accumulate Baba at a very, very low price. And it sounds maybe extreme to people at the time, but I don't have any question that this will be a trillion market cap tech giant. So again, our very little firm has taken like a 0.005% something exposure to Alibaba. And when that becomes the $1 trillion business that it truly will become, we're still going to own that piece. And it will be really, really valuable. So that's why we like Alibaba. We can just buy so much more. We can buy a great company, and there are certain risks, and we're aware of the risks, the VIE structures and all these kind of things. We watch them carefully. And of course, if something was going terribly wrong, we would pivot, and we wouldn't sit here and tell everybody we're pivoting. We would just pivot, and then we tell people later, and they'd get upset with us like we did with Seritage. But we're watching very closely. But if everything's working very well, this will be an incredible investment. I'm so pleased that we have this opportunity. When you find companies that get inexpensive like this, it's shocking to a value investor. We don't understand how a company that earns 200 billion, costs 200 billion, has 50 billion in cash, is buying back all their shares and earning 25 billion a year in EBITDA. Like 6 years from now, they'll have earned the whole enterprise value of the business again in cash. How can you possibly lose unless it's confiscated by the government, or something happens structurally? Okay, so we watch these risks, but the company is so inexpensive. Charlie Munger was totally right. late in his life, he was saying it's kind of just this damn retailer, but it's not just a damn retailer. I mean, it's a tech behemoth. And along with Tencent, Alibaba, and a few other firms in China, they're going to be up there with the Amazons and the Metas and the Alphabets and everybody else globally. So I think this is a really nice place to be. You have to have a little bit of thick skin because it's controversial. But when you find a great controversial with great financials, the future is usually very bright. So we've been selling puts, Brandon, as a tool to buy this for less than it costs in the market. And then in addition, when we get really good dips in the price, the long-term 2.5-year 2026, December 2026 calls are available. And in our portfolio, our position, let's see if I can jump to the conclusion, but we write puts and we're picking up cash, something called the wheel. Short term, if we get put something, we're exiting with a covered call and we're keeping that cash and then allocating it to buying our long dated calls. The reason we're doing that is so that we pay for time decay and volatility decay one time, and we pick up a ton of weekly decays in these option prices. So we end up with a series of free call options that are deep in the money in Alibaba, and they're essentially free. So we have built out a huge free position of BABA by generating cash and then using it to buy in the money call options. And they expire in December of 2026. So you can imagine what the capability is there. It's very promising.
Why don't more people do this strategy? Is it applicable for an everyday person like myself? Because you've got this, this retail investor pathway of paying a broker to obtain shares, and then you've got your way of doing it, of selling puts, where you either you're being paid to take shares, which is fantastic. Is it something that, like, realistically I could do, or is it something that's more only applicable to someone that has, a fund like yourself with millions of dollars behind you that can have that money to work with?
Brandon, you can definitely apply this, and it may start on a smaller scale, but there is in my own personal account, even in my spouse in America, we have something called an IRA, an individual retirement account. Even in my spouse's IRA, which doesn't have millions of dollars sitting there, I still write puts as a tool to buy the stock. I find it very irrational to go out and pay $4.50 for Seritage today. And I'll tell you why. I'm able to write a put promising to buy it for $3 and someone pays me 50 cents. So if the shares don't go below $3, I will make 50 cents on $2.50 in collateral. I'll make a 20% return over the life of this contract, and I don't even own the shares. And if we buy the shares, instead of paying $4.50, we pay $2.50. Just imagine the difference of what that would do. I highly recommend, if you watch a few of your videos, of your videos, I was going to say my videos, but you've even explained it in your videos. I've seen them. If you watch some of your videos, you just implement what you've already taught. You know it. It's not difficult. It's simple. Usually the step that stops people is the phone call to the broker to say, I need you to upgrade my account so I can write a put. That is what stops people. But once you're there, all you need to recognize is that you are going to take on 100 shares of notional exposure if you sell one put. That means if you say, I'm going to commit to buying Alibaba for 80, you're actually going to commit to spending $8,000 on Alibaba.
Right.
So it's not for the smallest portfolio, but it can be for a portfolio with $8,000.
Yeah.
And you will quite fundamentally, instead of paying $80, you will pay $70. And so obviously when those shares are worth, say, $560, for somewhat easy math, you'll have made 800% instead of 700%.
Right.
Okay, so you just outperform everybody else who owns the same stock. And I know you're a fan, as I am. I have a lot of respect for Manish Pabrai. I just read in his letter to shareholders for his own fund, Pabrai Funds, that he's upgrading legal documents this quarter, and starting next year, he's going to start selling puts. So this is a huge evolution. And by the way, Warren Buffett does this periodically.
Does he?
He doesn't always talk about this. Of course, yes, of course. So, and I didn't really know. It's not like I discovered he was doing it. I don't, this to me made a lot of sense. It's like algebra, but I've been doing this for 20 something years. Warren Buffett bought Coca-Cola selling puts. He bought Burlington Northern selling puts. So people don't realize the advantage that Buffett does by. Imagine Buffett's going to buy the entire company and he knows he's going to pay $40 plus. Well, he can sell every put that exists with a strike under 40.
That's kind of funny.
And it happens. And I would, it's not like they report this on the 13Fs. So imagine you've seen Warren Buffett buying Occidental for years. Now, do you think that and Warren Buffett isn't sitting there hitting the buy button. He has his traders buying. Now, do you think the traders are not taking advantage of every possible opportunity to buy Occidental? I would be very surprised if Warren Buffett is not right now, literally today, selling puts on Occidental, and they will expire in the coming weeks, months, and years. And if the shares are below 58, it looks like he bought. And everybody then says, where were the prices over the last quarter? Well, guess what? That's not what happened. He sold a put years ago and just got put the shares, and then they show up on the DFRE files with the regulators. So I would be, and maybe somebody can correct me if I'm wrong. Like maybe there's somewhere that somebody knows to find out, but I do not think it's public.
It seems illogical, yeah.
And I think it would be very logical, rational for him to be doing this. And it would not be very logical or rational for him to tell everybody he's doing this. So it's a great opportunity. And Brandon, I'll even go further with you right now and say, in our fund, we do take advantage of these little opportunities like this. And if you were to wait for Occidental to be under 60 and then try selling a put, that would be probably a really great place to start if you wanted to do one. And then when after you get the shares, you can sell them in the market. Imagine you offer to buy Occidental for 56, get paid $2. It expires in a couple weeks. You get the shares, and then you just turn around and sell them for 56 strike call, and you're paid another $1. So now you're in for 54, out for 57, and it's Occidental. Warren Buffett's just accumulated the shares. It's one of his favorite companies on the planet right now.
Interesting. And one other thing that I wanted to talk to you about, I don't know how into the weeds we want to go with this, is this concept of using options contracts to be paid to get in and out of positions. You're also now starting to, or you have been doing it for a couple of years now, you're starting to test whether you can capture a company's dividend or part of a company's dividend without too much financial penalty. Now, I believe there's a little bit more risk involved in this strategy, but can you maybe explain how that works and what you've found by trying this?
Yes, this has been a really pivotal discovery. I would go as far as to say it's a discovery. We are using a lot of technology. We've built internal proprietary software to help us execute this strategy, which is phenomenal, by the way. The fact that we've been able to get to where we are today is quite impressive. What are we doing? Let me start with the problem. The problem with a long-term value fund, like a Warren Buffett, is notoriously they have a huge cash pile and a cash drag. And specifically over the last decade, with interest rates in the US at zero, it is a huge cash drag, and the opportunity cost of holding that cash is high. And so I am really focused on maximizing IRR for our LPs. It is like the score The score for us is not AUM, it's IRR. So we are always looking at that. And I want to maximize the return that we can get on the cash, but also have the cash there flexible so that we can use it when there's a new opportunity around the corner. So how can you manage such a difficult dynamic? And it's something that all value and funds are trying to balance. So let's just take a step back and walk through it quickly. We start with our 13 Fs, and ultimately what it does, our software now identifies some of the key holdings that have massive dividends that are owned by these great value investors that go through a modeling quant high-level filter where we calculate all the ratios and we look for red flags, and then takes the 400 companies each quarter that are on the 13 Fs and suggests around 30 or 40 highly profitable trades for the next 3 months.
Right.
And this has been transformative. And we are testing and back testing, and we bought data and we're tweaking the variables, and we're trying to understand if we should be in the money or out of the money and how to optimize the time to expiration. But what we are looking to do, and you can do it with a single share, single put, we are looking to write a contract that expires just a week before the ex-dividend date, which is the date that they determine what shareholders receive the upcoming dividend. So if you have a company that's paying a 5, 6, 7% dividend, if you hold it across that date, you will get paid that dividend. But also if you do it with our approach, we're getting paid a put premium, then we're getting paid a dividend, and then we're writing a covered call on that stock the day after the ex-dividend date. That goes out just 1 week, and we exit back to cash. So this is like a very short-term holding. It could be on a Chevron, an ExxonMobil, an AT&T. A lot of them are blue chip companies, and they don't need to have the same growth moat characteristics, the quality management team that our infinite compounder portfolio needs to have. They just need to survive over the 3 weeks where we go in and grab the dividend and leave. And because we do it, it does not work without selling a put. It's been shown that it doesn't work. And a lot of people try to grab high dividends. It's not effective. But if you go in there and you get paid all these multiple times, paid a put, paid a dividend, and then paid a call. In our back testing, we look through 80 quarters. There are only 2 or 3 quarters where we end up with a net down quarter.
Okay.
And that's, I think, that's an important thing to hone in on, because as everybody knows, when the company goes ex-dividend, the share price will, account for the dividend being paid. But you're saying that there is risk in this approach, but is what you're saying that if you apply this as a rigorous strategy and you have clear rules around how you implement it, and then you implement it not just once but across many opportunities, then the data suggests that the risk is worth taking for the reward. Is that right? You wouldn't apply this, you wouldn't maybe take a chance on one stock that's paying a dividend next week.
Brandon, you articulated it very well. That is all correct. What we are looking to do is we take a basket of 40, and we know that within that basket, a few of them will not work, and the others will make up for it. So if somebody happened to choose the 5% of firms that were going to decline, that would be unlucky. But if they continue the process and they do one every month, that will be sufficient. They just need to keep going. So you can't go down and stay down. You have to put the capital back to work. And over time, we are absolutely finding that there is very real and very significant alpha. And internally, Brandon, it's very exciting for us. Internally, we have, we're working with the team at UNC. We've been working with a few different people developing our Python code and technology over years. and it's been a huge asset for us. When we're sitting here and evaluating these opportunities, we are now back testing nuanced situations and variables. What happens if we're one strike in the money on our puts versus one strike out of the money? And in the money concept just means that the stock's going to change hands at execution. So a call and a put are in the money and out of the money at different locations. But where should we objectively, with discipline, so that there's not subjective chance, where should we be writing these puts consistently? And we're testing for that. What we're now finding in our results, it's really wonderful, Brandon. It's like we're seeing some results in the teens, and then we're finding new opportunities where the 20-year back test shows us 20. And then we see new opportunities where we get into the really high 20s. And it sort of becomes a process where if we can be as disciplined as our algorithm, we should theoretically be reaching these returns on our cash. So let's see what happens over the next 1 or 2 years. We are doing this right now. We're up about 20% this year net, which is great. We're beating the market again. This will be like our 5th out of 6 years where we're 20% plus net. So I think we found something.
On that cash position?
On the fund.
Oh, on the fund. So we're talking about the whole fund here. Okay, yeah.
But, we have our infinite compounders.
Yep.
Those are compounding.
Yep.
And then we have our cash pile that's generating great short-term taxable yields. Don't worry, people ask about that. Yes, they are taxable. Okay. So we're making a lot of money here. And then when we find that next opportunity, we'll have built up this pile of cash and boom, we can execute and buy into that.
So really it's about the Peterson capital management is really about making sure that everything is, I guess, optimized. The cash on the sidelines is optimized. Your long-term compounders are optimized. It's about finding what you say, finding alpha in any situation that you can.
Yes, I think that really embodies it well. We have a process because it's very hard to point to an outcome and just try to magically achieve that outcome. So we've developed a very strict process where we go through 13F analysis, huge quantitative analysis, and then ultimately, if we find something we're interested in, we go very deep before we make any major allocation and buy a business. We're very deep into our companies in terms of research. We then look for every opportunity to pay less, sell puts, buy convertibles, use a warrant, whatever we can possibly do. And then we look at actual portfolio construction best practices. We allocate what many would say huge percentage of our assets to a given position. It's not really a challenge for us to put 10, even 20% to something. That's totally fine. There aren't that many great opportunities. So when you find a daily journal or an Alibaba, it's like if you're only going to get a few of these, you back up the truck and then you be patient. So every single step in our process is an alpha creating step over the long term, and it should lead us to great performance as an outcome. So we can control the process, prices move around, but we are very directionally right. We're very focused and objective on how we implement things, and we optimize everything, as you said.
Oh, thanks very much for your time, Matt. That was a fantastic chat. Really appreciate it. Really appreciate you taking the time. If people want to find you online, where can they look you up?
Yeah, right. So petersonfunds.com is the website. I think my Twitter handle is at Matt Peterson CFA. So definitely people can follow us on Twitter. We have a YouTube channel, so you can go and watch all sorts of videos like this, and you can watch past things from Brandon. Look, we have Brandon, the way that this works, we have funds can have 99 LPs. So you see fund managers running these massive funds. Well, generally they're 99 partners, and we have about 77. So we are slowly we're just slowly filling up our spots within the fund. and we don't have a lot of people who redeem. So we're just kind of like building the vehicle, and then we will keep carrying this on for, I think decades. And we're trying to build some enormous wealth for our long-term partners.
Yeah, it sounds fantastic, and again, thank you very much for your time, dude. That's it's great getting to talk to you again. It's always a really good conversation when I get to talk to you. So thanks very much for taking the time.
It's lovely, Brandon. You're adding a ton of value. I mean, I say it, but I watch you on YouTube, and I find your assessments impressive. I'm thinking like, wow, look at Brandon. He's done all this work, and I'm sure your audience is learning a ton. And hopefully they won't all go out and sell puts on Seritage because it's a little dangerous. But I think they could sell a put on Occidental or a put on Baba. And it could be a little transformative in their evolution of investing. Manish Babrai is going to be doing it. Warren Buffett's doing it. I've been doing it for decades. It's highly profitable. And I would encourage people to go out and try one and see how it works. It'll explain a lot.
Fantastic. Yeah, I'll have to give it a go myself. But Matt, thank you very much for joining us. I really appreciate it, and we'll talk to you soon.
Thank you, Brandon. We'll talk to you soon. Bye now.